Probably for the average investor, those three funds you mentioned are probably just fine.
I think it really depends on how much money that you have. We got Brian from Charlotte, North Carolina. He goes, hey, Joe, Big Al, this is Brian. My wife and I drive a Corolla and love iced coffee over alcohol.
Yeah, does that mean that he prefers iced coffee to alcohol, or he wants iced coffee on top of his alcohol?
Yeah, I think it's the latter.
Okay.
It's like, here, I'm just going to pour myself a big-ass jug of booze.
Put a little coffee in
I'm
it.
just going to top it.
Top it off with
Top
coffee.
it with a little iced coffee.
That's how I read that.
Isn't that how everyone drinks it? I wanted to know if and when you think it's worth diversifying past a basic three-fund portfolio. All right, the three-fund portfolio, you got total U.S. stock, total non-U.S. stock, and total bonds. I've read about factor investing and understand the argument about adding small caps, value, emerging markets, but is the difference in the long run performance risk worth the added complexity? I love to keep things simple where I can, but don't want to leave dollars on the ground. Dollars on the ground.
I don't know that one. I've heard dollars on the table.
I've never heard dollars on the ground. I love that.
You don't want to leave dollars anywhere.
You are leaving dollars on the ground.
Just pick them up.
Isn't there like a song, something like something on the ground? Something. No. All right.
Maybe.
Thanks for your thoughts. All right. So, Al, what say you? I'll let you. I've been talking a lot. I'm all jacked up on Celsius.
You have been talking a lot.
I feel like
so. I would say. Honestly, probably for the average investor, those three funds you mentioned are probably just fine. Total U.S. stock, total non-U.S. stock, and bonds. Those are three great portfolios. You'd be fully diversified. The reason why a lot of advisors and others go to the next level, right? So small caps, mid caps, growth versus value, international stocks versus emerging markets is all of those different asset classes have slightly different expected long-term returns. Small cap and value tend to outperform large cap and growth. However, in the last 10 years, that has not been true. But if you go back 50 years or more, that's been true. Emerging markets, more risky, outperforms other types of international stocks. The last 5 or 10 years, not really so much. So it just depends. But yeah, the reason people do it, a couple reasons. One is to add a little return in their portfolio long term. And secondly, is if they got stocks outside of a retirement account and different asset classes move at different times, they go up and down. If one goes down, you could sell it, tax less harvest, create a loss, buy something similar, right? Maybe not exactly the same. If you only have three funds, it's harder to do that because everything's stuck in one fund. But yeah, I would say for the average investor, the three funds you recommended, as long as they're low cost index type funds, ETFs, that's a great way to go.
So here's the theory behind it. I think it really depends on how much money that you have. If you have a few $100,000, I think three funds is great. But as you have more dollars, you can have more tilts, if you will, towards different asset classes. Because if you put $10,000 into a small value fund in a $200,000 portfolio, is it really going to move the needle? Maybe, maybe not. But as you have a larger portfolio, there's more complexity that you can get into. So let's say you have a 60-40 portfolio and I want 60% stocks and 40% bonds. And let's just call it the total U.S. stock market. The total U.S. stock market, you're going to have small companies, you're going to have large companies, you're going to have value and growth within that over total stock market index fund. But I have 60% in stocks, 40% in bonds. So as people age, they want to take on less risk, but they still want that high expected rate of return. And so by diversifying into different asset classes, especially, let's say, smaller value, that is going to be a little bit more volatile and give you a higher expected rate of return over the long term, you could take less risk in the overall portfolio, but in your stock component of the portfolio, you can add that risk to get the same return, but you're actually minimizing your risk. So what I mean by that is, let's say the total market is going to do 10%, hypothetically, this is total hypothetical. The total market does 10% on average per year, but small companies over the years has done 13%. They're going to give you a higher expected return, but you're going to receive more volatility there. So if I still want to maintain that 10% rate of return in my stock component of it, I could put small caps, but now I don't have to have 60% of my portfolio in stocks Maybe now it's 50% in stocks, but I have a sliver in small companies, or I have a sliver in emerging markets and things like that that are more risky that will give me a higher return. But I'm overcompensating on the bond side. So I have less risk or market exposure with the same expected rate of return of the total market. That's kind of the theory and the academics behind it. So yeah, are you leaving dollars on the ground? You could be leaving a lot of dollars on the ground. So, but if you want to keep things simple, right, there's cost for complexity. So, I mean, if you want to keep it simple, you're still probably going to get a really good return. But if you don't want to leave dollars on the ground, get a little bit more complex. It's going to take you a little bit of time to do it, and it's probably going to take you a little bit of work throughout the year. So,
I like things simple sometimes, Joe. So I'm still okay with my answer.
oh, you're a simpleton.
That's right.